So without further ado, I guess, I just want a quick question is, who'd like to put an extra $15,000 of cash in their pocket this year? All right, he walked in at the right time. There you go. I'm handing it out. We're doing a raffle.
Because we had
From the IRS. Oh, really?
I
learned my lesson last
Yes, exactly.
Yeah,
Take it. Went off.
I'll give you a stamp.
Oh, okay. Yeah, take it. Okay. So I won't be giving you specifically $15,000 in cash, but vis-a-vis the IRS savings, you'll be sending in that much less to Uncle Sam after we go through what we call our 7-step realtor tax solution. And then after we walk through all of those steps and I get into what everyone's favorite topic is right now, it seems like, at least in my world, is tax reform and the changes it's going to affect you as a business owner and then also potentially your clients when they're buying and selling homes. So, and for those of you who came in late, there's a form right here to fill in the blanks as we're going. I think we got one there, and they're up here. So, kind of walk through our 7 steps really briefly. Step 1 is to put your business into a sub-S corporation. Does anyone have their business in an S corporation here? Awesome. So we got a few in the room. What's that?
My wife.
Okay, great. Step 2 is to rent your personal home to the corporation for its shareholder board meeting. I'm going to show you how you can get a few $1,000s a year cash doing that. Step 3 is to get your books on autopilot and get them out of your hands, because for most entrepreneurs and in our experience, especially real estate agents, doing books is like pulling teeth and going to the dentist. It's just not anything you want to be doing.
Gut-wrenching.
Exactly. Step 4 is to tax plan proactively. That's your best use of your CPA is before the year ends in November and December, not coming up in February and March. So we'll talk about that and why. Step 5 is to hire your children. Implement some really good child labor laws here. Anyone have kids under 18?
That are 18?
Under 18.
Oh,
Okay, so we're going to show you how you can save a few $1,000s a year by putting them on the payroll.
Should we be filling it in now, or we're going to?
No. Yeah, I'm just overview. No, it's sorry. Don't have to fill it in just yet. I love the note takers though. I love the good students in the room. Step 6 is to make your children's college tuition a business deduction. Do we have any kids with college or with kids in college? Okay, so you're going to love this one when we get there. And then step 7, this is kind of a mouthful, but to use a multi-entity fiscal year-end corporation to save and defer potentially over $100,000 in taxes. And this one really makes sense for those of you who might be above a net income of about $200,000 a year. So it's not for everybody, but it works really well for those who are. Step 1, now this is where you can fill in the blanks on step 1. Form a sub-S corporation, and doing this is going to reduce my self-employment tax, and it'll save me potentially almost $13,000 per year. So self-employment tax, for those who don't know, it's your portion of Social Security and Medicare as a self-employed individual. So when you're a W-2 wage earner, you get your gross pay, and then you have an amount taken out for income tax, and then an amount taken out for Social Security and Medicare. That's about 7.5% of your pay. Then your employer matches it and sends 15% to the IRS. That's payroll tax. So as a self-employed person, there's no one to withhold that money from what you earn, and there's also no one to match that other half. And so you're left, the IRS still wants all of their money on that, so you're left with paying an extra 15.3% on top of net income, or on top of income tax in self-employment tax. And that's fine, because you're building up a nest egg for retirement and Social Security, a very small nest egg, but on amounts above about $45,000 per year that you're paying in on that, up to the maximum $128,000 that it's subject to, only 15% of that total tax is going into your actual retirement account. The other 85% is going to the general fund, welfare programs, Uncle Sam's coffers. So
repeat that.
So on amounts above $45,000 of net income, so to break down the numbers, on the amounts 0 to $15,000, 85% is going into your actual account. So the tax on that first $15,000, almost all of it's going into your actual account. On the amount between 15 and 45, that drops to 35%. And then 2/3, so the other 2/3 is going to the general fund. And on everything from 45 to the maximum 128,000, So basically $13,000 of your tax, only 15% is going into your actual Social Security totals. The others go into just the general fund, which is nice, but I'd rather have that money going to you. So S corporation earnings are not subject to self-employment tax. So what happens is you pay yourself a small wage. So say it's $45,000 as a wage, and you make the maximum subject to self-employment tax. What happens is in a sole proprietorship, which for those of you who don't have an S corporation right now, that's what you are. It's a 1099, basically. The full $127,000 is subject to 15%. So that's almost $20,000. And then if you go through an S corporation, you have an officer wage of $45,000. You pay that 50, and I can send you the slides. So don't worry about, yeah.
Awesome.
Don't worry about snapping pictures.
How easy is that?
And then actually we're going to be uploading this to our YouTube channel in about a week or so. So yeah, so you'll get the full copy of this as well. Be able to link out to it. And we'll send you that link if you want a copy. So $45,000 is an actual run through a W-2. And that amount you pay the 15% on. So you're maximizing that. That also happens to be the average wage for a real estate agent in the state of California. And then the other 82 comes through a K-1, which is basically S corporation net income. You pay the tax of the net income of the business on your personal return. There's no corporate tax other than a small state fee. So your income tax is exactly the same, but your self-employment tax, which becomes payroll tax, and it's only $6,750 instead of almost $20,000. So that's where that savings comes from. The other thing is your audit risk drops from about 2.3% as a sole proprietor. An S corporation's chances of being audited are 0.4%.
That is the sole reason we S corp.
Yeah, so you're just,
Aside from this,
I mean, this is nice. This is a nice perk.
byproduct.
Yeah.
You were like, okay.
So they just don't have enough auditors that know how to do S corporation audits at the IRS, and so you're almost 8 times less likely to be audited as an S corporation.
Isn't real estate agents, are they almost the most audited? I mean, you said 2 point something, but
I don't know the audit rates by industry, but across the board in the net income of about $100,000, it's about 2.3%. Okay. What triggers those a lot of times is if you take too much of one different kind of expense. Mm-hmm. So if you've got way more because what happens is you put a business code on your tax return, and then the IRS runs that against every return with that business code on it. And if anything jumps out as way too high or way too low, then they'll pull it out of the system for audit. Yeah. So that's what we like to do is when we're running numbers, our software has those benchmarks in there, and so we can run them and see, okay, are we too high, too low in some areas? So that also allows you, in addition to this savings off the bat, it allows you to be a little more aggressive because you're just 8 times less likely to be audited, which is nice. A little peace of mind there. And we're going to have in these different steps some T's to cross and I's to dot, we call them. These are steps you want to make sure that you're taking to make sure that it all holds up. And any questions on that before I move on? Because so we're going to talk a couple different strategies, and there's 2 different kinds of tax savings. One is permanent savings, which means it's savings forever. You never have to pay it back. The other is deferral, meaning you're kicking the can to next year. Most tax planning is deferral. Write these $10,000 of checks before the end of the year to get the deduction now. Well, next year you're going to have that many less deductions. This is permanent savings. It's never pay it back.
And this might be another class, but how do you start an S corp?
So we actually form corporations for our clients. So it's just you submit some forms to the Secretary of State or a corporate book, and then there's some paperwork, bylaws, minutes.
You need to hire someone to do it, honestly.
Yeah.
We did. We couldn't do it. Do you also do the minutes?
We do all the minutes, bylaws, review everything step by step, issue the stock, and we do the annual minutes with the tax return.
Okay.
We had an attorney set up.
Yeah, same here.
Okay.
Yeah.
Yeah. So we do a lot of new. I mean, 20 in.
I don't suggest doing it yourself. It's kind of like
What tends to happen if you go to LegalZoom and try to do it yourself is we get clients or new clients that did that. They bring us their book. There's no bylaws filled out. They didn't actually issue any stock, and so if they got audited, number one, the IRS is going to say this isn't really an S corporation and hammer you for a bunch of payroll taxes and penalties. The other part is you have no liability protection if you're not setting that up correctly. So as I mentioned before, the Department of Labor says that a median realtor's wage is $43,370. So that's how we get that. You want to make sure that you're using a justifiable wage, because if you just say, okay, S corporation, hooray, zero wage, well, that's going to get you audited really quick, because the wage is kind of the bone you throw the IRS saying, okay, we're going to pay some tax. And so you want to have a justifiable number there. Step 2. Any other questions on step 1, form a corporation, before I move on? The break-even point is about $50,000 of net income on when it makes sense to form an S corporation. So just as a gauge, $50,000 of net income. So that's after expenses, and that's because the savings compared to the cost of maintaining the S corporation. So step 2 is to rent your personal home to your corporation for your monthly shareholder board meetings. And this is something you can't do as a sole proprietorship, by the way. It's got to be a separate entity. So the IRS has a rule that lets you rent your home, your personal home, if you own it and it's your principal residence, for up to 2 weeks a year, and you don't even have to put that income on your tax return. So what this is meant for is if you're going to Hawaii for a week and you want to get part of your trip paid for, so you put your home up on Airbnb and you rent it out for a week. Well, the IRS says if it's your principal residence, it's under 2 weeks a year, you're not really in the business of renting at that point, so you will give it to you tax-free. And so what we do is we have our corporate clients rent their home out to their corporation for their monthly shareholder board meeting. And so you hold a meeting with me, myself, and I. This works really well if you have a split personality, and have a conversation with yourself about, you're thinking about business at home all the time. And so you cut a check from your business account to your personal account. It's a deduction as rent expense to your business and tax-free to you. And so what happens is you use we say, what could you get if you rented your home out for a backyard wedding? And then as a rule of thumb, we say about 0.1%. So if your home is worth $500,000, we do $500 per meeting. So times 14 days per year is a $7,000 deduction. So you just cut that check. We recommend you get it set up on auto draft so that I can't tell you how many clients we've talked to. They're like, man, this is an awesome idea. It's free money. And then we talk to them 5 months later. Hey, have you been cutting those checks? Oh, shoot, I forgot. So set it up so it takes the same amount out each month. And we've got clients that are over in the Bay Area doing $2,000 per meeting on this because their homes are worth so much over there.
So it's based on the value of your home?
Roughly, yeah.
That you're doing the rent.
Yeah.
So markets fluctuate, that has to fluctuate.
Yeah, definitely. And that's just a general rule of thumb, and we say pigs get fat, hogs get slaughtered. So if you get too aggressive, then you don't, it's free money, but you also you want to leave a little bit on the table.
So 0.1%.
About, yeah. So home's $1 million, $1,000 per meeting. Home's $500,000, $500 per meeting, roughly.
What documentation must you keep in case of?
Great question.
The IRS would just disallow the whole thing.
Yeah. So great question. And we've had this audited and won and audited and lost. And when it's lost is when they just say, just give me the write-off. When it's audited and won every time is when you physically cut that check. And then you have minutes and actually write down, dated for when that check is cut, what you discussed at that meeting. And so it could be determine my number of homes I want to sell in 2018. It could be I'm going to hire a transaction coordinator in 3 months. Just business planning, and you just document. When we form the corporation for our clients, we give them a copy of blank minutes. And then we send out a reminder email to all of our clients once a month. Hey, here's a reminder to fill out those minutes. Here's a sample one for your reference.
Must the minutes be in like Robert's Rules of Order format and all of that stuff? Or
no, just something documented, dated, and signed.
By the stock.
Exactly.
Okay.
Yeah. Something that shows you actually physically did this and you're not just trying to be fancy.
Okay.
Trying to be tricky. So yeah, physically write the check and actually have those minutes documented.
It's really happening. It's really happening.
Yeah, and the rationale for this is the office can get busy. It's crazy, things are going back and forth, moving around, getting interruptions all the time. So you're getting off-site to do your monthly planning.
Is that what you call it, offset monthly plan? Or?
Yeah, offsite shareholder meeting.
Can you do it in Mexico?
So that you can, but you wouldn't get this free, you wouldn't get the free money because,
Deduct in pesos.
yeah,
Home, you rent your house out for it.
yeah. And so this is,
In Mexico, you're giving
My
somebody else the
timeshare.
money.
yeah,
What about my timeshare?
we can talk about that maybe.
Sorry.
That's okay, but so this is different just to highlight from the home office deduction. And it's an either or. So if you're taking the home office deduction, you can't take this because if you're taking the home office deduction, it means you're regularly conducting business in there. So that would put you by definition above that 14 days rule. We've run the numbers and every time this is a better deduction than the home office because you already get your mortgage interest deduction and those other things. So this ends up being a better deduction for you. Any other questions on renting your home out? This is another permanent savings. It's free money. Step 3, get your books in order and on autopilot. And so the Entrepreneur Magazine put out an article about a year or so ago now that said the average business owner spends 155 hours per year on their books and taxes. How many listings can you get if instead of trying to plug numbers, you're calling leads or door knocking 155 hours? Quite a bit. So having a system to set it up so that it runs without you is going to help you keep a good set of books. And a good set of books is actually something that saves you money. So taking your bank account and reconciling it to the books, making sure that you're deducting all of those expenses, make sure you pick up all those expenses and actually ends up saving you money by having a good set of books. Because when you think about it, so say you're in the 25% federal bracket, 9% state for California, and then now with self-employment tax, if you're not an S corporation, that's 25, 34, 49 cents of every dollar you miss as a deduction, you're cutting a check at tax time. So if you miss $5,000 of expenses because you're not keeping your books up to date and you've got the shoebox of death combined with the spreadsheet that you hope is correct, then you're losing out $2,500. You're on $2,500. And so getting those books set up so that either you hire someone to do it for you or you've got it set up where you're importing your transactions and doing it regularly is going to be huge. And so what we recommend is you get set up on QuickBooks Online. What's nice about QuickBooks Online is it's web-based, so you can do it from anywhere. There's an app on your phone. You can see your numbers, how you're doing on your phone anywhere. And then for us, about 90% of our clients are on QuickBooks Online, and it really makes it really nice because if they call up and have a question, we can just pull up our QuickBooks and it's right there with real numbers, up to date, and we can both be looking at the same set of books and actually be making decisions with based on financials, not just because it sounds nice. And so that's where you really make that transition from being someone who sells homes to someone who's running a business that's in the business of selling homes. And so step 2 is getting that set up to automatic. So like I said, either hiring someone to do it for you or getting the bank feeds set up and making sure that you've got a time set aside each week to import and update those numbers. And then reconciling your account where you pull your bank statement, pull up your books, and compare the two to make sure there's no errors. And then third is to use some sort of receipt scanning software. And so if you have QuickBooks Online, there's actually a function within the app that lets you take a picture of the receipt and attach it to the expense right there. And it's really nice because then you take the picture while your memory's fresh, and then you don't have to worry about shoving it in your pocket and then it goes through the laundry 8 times and then you pull out a blank receipt 6 months later. Or just, you have a meal, a business meal, and you put it on your business card, which is great, but then they pull those in an audit and they say, who is this with? Well, I don't know, that was 8 months ago or 2.5 years ago. How do I know? Whereas if you write down who you met with, what the business purpose of the meeting was, take a picture of that receipt, then you can throw it away and you don't have to worry about it. And a couple other apps are Receipt Bank is another app. And that one syncs in with your QuickBooks Online and actually reads the vendor and the amount and plugs it into the books for you, which is pretty sweet. And then Expensify is another one. And I can tell you it feels amazing to be able to just snap a picture and throw it away, and that's all you have to do with your books. So like that's how, like our monthly bookkeeping clients, all they have to worry about is taking pictures of receipts. Everything else happens for them. So
The QuickBook, we just go to online and just load the app, right?
exactly. So there's an app on your phone, or you go to QuickBooksOnline.com, log in, it's right there. Yeah, and for those who are wondering, just having a business credit card with the statement isn't enough, because if you're going to AM PM, you think, okay, that's a gas station, of course that's gas. Well, the auditor has told us, well, how do I know you're not buying beer? So just snapping a picture while you're at the gas station, print that receipt, snap it and toss it. Now you have record that it's actual fuel, not snacks and beer that you're buying. And same thing with meals. And for a meal to be deductible, you need 5 things. You need 3 of them. The first 3 are on the receipt. It's where did you meet? What was the date? And what was the amount? The other 2 aren't on the receipt, and I recommend you write them down on the receipt and then take the picture. And that's who you met with, and then what you discussed. And what the IRS is saying now is, because it's so easy to take pictures, they want to see a little more detail on that receipt. So who you met with and what's the business relationship of that person is best practice.
So with QuickBooks Online, it has the receipt scanning
Yeah.
software. You don't need this other app.
You don't need it. So it's personal preference. So like with QuickBooks Online, you have to take one extra step, because you have to actually add the expense right there and categorize it as meals and entertainment and put in the amount. With Receipt Bank, and it's like $15 a month, you take the picture and then they do it all on the back end. They read the vendor, they categorize it for you, and then they plug it into your books. So it just depends on how much you want to totally outsource.
Thank you.
But yeah, good question. Any other questions about getting your books on autopilot? And this is just real quick on the importance of a bank reconciliation. Make sure that you take all those expenses as a deduction. If you have an assistant plugging in your numbers for you, having someone else do the bank rec is key, because the person who's doing the bank rec is really the watchdog of the finances. Because one thing about QuickBooks is it's great for efficiency and simplicity, but it's really easy to embezzle from. Because you could write a check. We actually had a client that this happened to. They wrote us 2 checks once, and we said, we didn't get 2 payments. Hold on. Well, we went and we called up the client and said, hey, pull up your bank statement, look at the copy of the checks. Well, one was to us and the other was to their bookkeeper. She had written a check to herself, gone, cashed the money, gone back in and changed the vendor in QuickBooks.
Oh my God.
So having someone else, an outside party, or just a second person from the person who does the data entry and writes the checks, do the bank rec. If you have someone that you're hiring out, as assistant to do that, definitely makes sense. Step 4, tax plan proactively. As I mentioned before, the best use of your CPA isn't in this coming time, February and March, because at that point we're just historians. We're just filling out the numbers that have already happened. It's November and December before year end, so that you meet with us, we run numbers, anticipate about what you're going to owe, and then give you a list of marching orders to do before the clock strikes midnight on New Year's Eve to save you a few $1,000s. And so really being in a point where you're tax planning proactively is going to make your CPA a profit center for you, not an expense of just doing the compliance and filling out the forms. And so we have some, for us on tax planning, we have a lot of people that meet with us in either November or December. Just do the numbers, this is what you're gonna owe, here's the orders. If you've got more complex things with multiple entities, we have people that meet with us in July, and then again in September, and then again in December. And so it really depends on your needs, but just at the very least, sitting down with your CPA before the year end so they can give you a list of things to drop a few $1,000s off your taxes is huge. Now, one thing you want to do, especially in people in real estate, a lot of your money isn't just made on commissions. It can be made on buying deals because you have access to deals at wholesale rather than market price. And so you want to make sure that you're determining your potential borrowing needs for the next 2 years, because we can tax plan you into the poorhouse on paper where it looks like you're making no money at all and make it so you can't even qualify for a car loan. But we need to balance that with basically your taxes are your purchasing power. And so we look at your next 2 years of potential borrowing needs. Say, we have a client in the Bay Area who they made like $1.2 million last year, but we could bring them down to $150,000 of net income, but they need their income, their AGI to be 380 for their borrowing. So we plan that so that they're exactly at that and not a penny more. But you don't want to get to where you're trying to buy a home and then, uh-oh. So step 4.5, whose head is spinning right now with all the concepts? Excellent. So I'm gonna have Andy pass out really quick. We always like to take just kind of at this point, pause. There's been a lot of concepts and numbers thrown around. Just pause for any additional questions. And Andy's handing out a form. If you want a copy of the slides or more information for you specifically on any of these steps, just check those boxes and then we can follow up with you and see the slides. We're in Ripon, so a little south of Stockton.
Yeah.
So yeah, a little over an hour south.
So you do
So-
everything pretty much, just email or
So technology allows us
meet up, do we do FaceTime?
we can. So technology allows us to basically we have clients in Maryland and Texas and New York, and but there's still sometimes face-to-face is nice. So we do a lot of it's through phone calls and emails, and then we have Zoom for face-to-face video calls. But then I was just up in Roseville about a week and a half ago with clients and given another speech, and actually for the other Lions office, and then so we're around all the time, and so we can schedule face to face. But yeah, we're down in Ripon. So quick recap: we got S corporation, shareholder rent, get your books in autopilot, and tax planning proactively. Any questions on any of those? All right.
I have a
Oh, yeah.
question about- So
Okay.
we have an S corporation, Cheryl
Okay.
and I. So Cheryl's also employed by Lion Real Estate.
Okay.
So last year, we did not pay ourselves nearly as much out of the corporation as salaries,
Yeah.
just by sake of not needing.
Mm-hmm.
So we, this year, 2017, will be paying a higher
Officer wage.
the schedule.
More,
The-
officer wage, yeah.
So through payroll.
Yeah.
Yes.
Less, we paid ourselves much less last
Okay.
year than
From Lions or from?
our own personal corporation.
Okay. So but you're going to be increasing it this year?
It'll probably stay the same this
To the
year.
same. Okay.
So my question is maybe this is something side, but we paid ourselves a larger Schedule K at the end of the year.
Okay. That's
I'm talking about red flag.
red flags. So it depends. So if it's
Household income.
if it's 10, yeah. So the household income is on your 1040. The 1120S, they look at the income compared to the officer wage. If it's just a couple $1,000s,
Okay.
then that's gonna throw a flag.
Cognizant of that, okay.
Right.
The
But
dividends versus the wage.
yeah.
Setting it.
But you would only need to pay you payroll. There's no point in paying her extra payroll.
Sure.
You just need one officer wage.
Okay.
So
Does that mean I don't get to rule the corporation?
you can be the ruling officer, the commanding officer.
The word distribution or a dividend, there's no dividends on an S corp, are there?
Well, it's called a draw. I mean, it is
Distribution, isn't it?
it's technically a dividend, but it's called a shareholder distribution. Yeah.
I call it the
I call it distribution.
paying your quarterly taxes.
Well, see, what we like to do is you take all of your withholdings out of the officer wage, and that ends up being almost a nothing net check.
Yeah.
Then you don't have to pay quarterly estimates, and then whatever else you need to live on, you have your shareholder meeting rent for a few $100s a month or whatever that number is, and then the balance of what you need to live on you take out as a draw. So that instead of paying quarterly estimates, you're just having all those withholdings taken out of your paycheck, and then it's just a tiny net
Because you don't
check.
pay self-employment tax on those draws.
Right.
Yeah.
Yeah.
You need to escort.
I am an S
Oh,
corp.
you are. That's right, you are. Land, maximum land, right? Yeah.
And if you do have, a husband, wife in the business type of thing, a good strategy is to only pay one of you the real wage at a time, and then flip-flop it after 10 years, depending on what your income history is, because the way Social Security works is it takes your highest 10 years.
It does, yeah.
And so if you're paying both of you an officer wage, you're throwing money away. S corporation that's in your child's name bills your main real estate company for a profit annually of about what the cost is for school. So let's say it's $30,000 per year. Say you, between your $45,000 officer salary plus another $25,000 in marketing expenses. So you've got $70,000 in expenses running through that company. You would bill your real estate S corporation $100,000 throughout. You just send them invoices throughout the year, and then that real estate company pays $100,000 to the company in a kid's name. So the child then claims themselves, picks up a net income of $30,000. If this plan makes sense for you, you probably make too much to get the education credits. So now the child claims themselves, gets the $4,000 of education credits, and that $30,000 is totally tax-free because that happens to be the number where your income is tax-free.
So I have a question,
Mm-hmm.
because, for instance, where Jake is going to school, you have to fill out, it's a private college,
Mhm.
and you have to fill out the CSS profile.
Okay.
And one of the things that, kind of as we were reading about it, it says that you don't want to put income in your child's name, or, because they do ask you about how much you have in your savings account.
For like the FAFSA type of thing, or?
There's the FAFSA
Mhm.
you have to do, and we don't qualify for anything
Mhm.
there, but at USC, it's $73,000 a year.
Yeah.
And the school utilizes the CSS profile, a kind of a more detailed
Okay.
document. It's about 27 pages, when you look at it. And they're asking very specific questions like, do you have life insurance? Is it whole or term?
Okay.
Are your kids going to be heirs to any type of inheritance?
Mhm.
So it's very, very specific.
For financial, so they're getting like financial aid through the school type of a thing?
Private colleges, they have the ability to give you a substantial amount, like even some, like the Ivies, they can give you up to $50,000-$60,000
Mhm.
in school grants. If you
They're not loans, they're just grants?
Correct.
Okay.
Which is kind of where we are.
Yeah.
Because of the cost of
Mhm.
the education.
Absolutely.
So, and it's specific to, individuals.
And so them having income throws that off?
Correct.
Okay. So that would be one of those individual cases of tax planning proactively, of looking at the numbers, maybe talking to the school and saying, is it earned income? Is it unearned income? What throws it off? Or is there a certain threshold where they can have a net income? And that's going to be offset by this. So maybe the tax savings is more than the grant. So as a total family unit, you're still paying less tax, even though you're not getting as much grant. That would be a kind of a case by case. Let's look at that.
Yeah, because the grant
Scenario.
amount that we were given is, made it so that it was cheaper for him to go to a private college than to go to a state college.
Wow.
So that's
That's
how
awesome.
generous they can be.
Yeah.
And depending on how you adjust your
And
numbers,
how smart your kids are.
Yeah, that helps.
so depending on how you adjust your numbers,
Yeah.
there are a lot of private colleges where if you show that you make, like, let's say 80 or under 100, a lot of the Ivies, your kid gets in, it's a free ride for them.
Okay.
So over the life,
Now, is that based on factored on parents' income too?
yeah,
So-
it's totally,
So that's where tax planning might be really sweet.
Really smart.
Beat your income way down.
exactly.
Jack those
We
grants
try to
way
screw
up.
ourselves where we should have been really thinking about it. I mean, thank God it's been a blessing for us
Mm-hmm.
in that sense, but we really should have started this probably like junior year of, if we had worked with someone to reduce our income.
Yeah.
Because that's the year before that they look at.
Yeah.
So, but that's the thing where I'm
Mm-hmm.
interested to find out, how do you play with those numbers?
Sure.
Make it so that it,
Yeah.
you are still paying a pretty penny out
Yeah,
of your pocket.
sure.
It's just that the schools are, like I said.
Helping out depending on.
Extremely generous.
Yeah, so let's talk after, and we can dive a little more deeper into that, and then
That's tax planning.
As absolutely tax planning. Yeah, run the different scenarios.
If you start running it down to do this, then you want to buy a house, guess what? You can't qualify.
Yeah.
So there's a lot of factors, and you should, everybody that is thinking they're doing their taxes themselves and understanding what the plan is, that's where CPA is going to come in.
Ours is
Because
35.
I know for me, had I brought my income, and there's a lot of ways to look at the balance sheet.
Mm-hmm.
I might not have qualified for my house that I bought last year had I brought my income down to $40,000.
Yeah, exactly. Mm-hmm. And those lenders got to check their boxes.
Oh, yeah, they do. And there's no income, no assets.
Yeah, yeah.
None of that anymore.
Uh-huh.
Those were great for self-employed.
And the ninja loan is even better. No job,
No job.
just a good FICO. All right. So any other? That's a great question and a perfect, like you said, example of tax planning and meeting and running the numbers about what makes the most sense based on all the factors of borrowing needs, grants, and then taxes. And so, to kind of continue, how that would work is if you had an adult that you're supporting, like in that. So as I mentioned to a couple of you in the room, my father and I are partners, and he supports his parents, and so that's how kind of we came up with this plan is how can we make that deductible, and that's how this was born. And so you would do the same thing with your parents that you're supporting, and they're at a lower income bracket, and so you just is basically at that point you don't get the benefit of the extra $1,000, a few $1,000s of education credits, but you're going from maybe paying tax at 33% to 10%. And so that's a savings gap right there. And the one caveat on the crossing your T's on this is your child, for a dependent who's a student under age 24, their earned income must be at least 50% of their annual expenses, or at least what they could live off of. So the poverty level in California for one person is about $10,000. So we want to make sure they have a W-2 of at least $5,000 or $6,000. And so that can come from if they work at Starbucks throughout summer college job, or we pay them a small W-2 out of this company. And these are kind of the numbers. You've got, speaking of doing it early versus, they're sophomore going into their junior year, so you got the 2-year plan currently in school. This is still, you're getting a deduction of about $100,000, $50,000 a year, all the different expenses, and again, I'll send you the slides. $19,000 in savings on a 2-year plan, 6 years of transferring it to the second child if you've got 2 kids going through school, about $52,000 in savings. So, beats a poke in the eye with a stick. So step 7 is to use a multi-entity fiscal year incorporation plan. I'm going to go kind of through the, and the other thing I want to highlight, because it applies to step 7 too, if you're taking $100,000 running it through your kid's company, you don't have to have $100,000 of cash sitting in the bank. If you've got $15,000 of cash sitting in the bank, throughout the year, you'd just cycle it through 7 times. So you'd pay from your real estate company to their company, pull the money back out, and put it back in to your main company. So this is a plan that we actually have someone deferring about $3 million on as our biggest deferral on this. So how this works is you've got your real estate agency S corporation, like we discussed before, your main business. It's got a 12/31 year end, like normal year end, calendar year end. Then you create a second company. It's a labor and marketing company. And it's got a November 30th year end. Throughout the year, using the same numbers that we discussed with the college plan, only this is in your name. So say you've got $70,000 of expenses running throughout here, and then you're billing $100,000 throughout the year to the real estate agency. This company generates a $70,000 loss and is billing this company, but this company is a bad customer and doesn't pay its bills throughout the entire year until the month of December, after this company's year end, then pays down all $100,000. And then you get a $100,000 deduction from this company that's not taxable to the marketing company for a whole nother year.
So this is that deferred.
Exactly.
So that bad debt.
And they both pass through to your personal return. So you get on your personal return in the first year a $70,000 loss in this company, and then a $100,000 deduction here. And then just keep doing it over and over and over throughout the life of a 20-year career. Tax savings on that. What can you do with that money if you're, so this isn't a buy a nicer car plan. This is if you're going to grow and invest in your business plan, because essentially it's an interest-free loan from the IRS. We call it our crack cocaine plan, because once you take a sniff, you got to keep hitting and keep deferring. Otherwise, it's going to be real painful, and you got those withdrawals. Because if you don't do it the next year, all the tax comes due. And on a cash basis, meaning you recognize the income when you receive the money and the expense when you pay it, you can prepay up to a year's worth of expenses in advance. So you could actually, that $100,000, you could do an additional $100,000, so get a $200,000 deferral.
And you said this has an income threshold.
Of about $200,000 of net income for it to make sense, because tax planning is mandatory under this. Otherwise, it all comes due. And so these are the type, we like to at a minimum run numbers in October and then again in December to tell you, calculate the numbers and say this is what you can defer, and then give you instructions on how to do it. And then in December, look at it again to make sure you transfer all the money correctly.
So question, and you're running basically 2 S corps, you're paying 2 tax returns.
And so
Plus
that's
your personal tax return.
right.
So you're looking probably, 10 grand a year in tax to your CPA.
Rough.
I just want to.
Yeah, and so that's why the net income.
Makes sense for everybody.
No, because that the net income of about $200,000.
Net income of 200 is a lot.
It's a lot. It's a lot, and so this isn't for everybody. And the reason why is because at a net income of 200, you've got enough expenses running through the business where you can build up that deferral and drop your taxes way down. So it's not for everyone. The S corporation, it's more like $50,000 to $60,000 of net income, just the one S corporation. This isn't for everybody. Yeah, full disclosure. And so how it works is I mentioned if you don't have $200,000 sitting in the bank to defer $200,000. If you've got $40,000, you have your $40,000 cash throughout the year to fund all of those expenses. You take a draw out of your real estate agency to you personally, put it into the marketing company, and then pay the expenses. You do that from January to November, and then you've got the year end, so you don't go between the two. Otherwise, it's an expense and then income, and you don't build up the deferral. During the month of December, it reverses. And now you take a draw out of the marketing company to yourself, put the money back in your real estate agency, and then pay $40,000 of bills, pull it out, put it back in, pay $40,000 of bills, rinse and repeat until you get your deferral target. And we've had this audited twice, and it's won both times. So
Once you come to a year where you end your career and stop deferring, will you and the taxes come due on 10 years of deferrals?
Yeah.
Are they paid at the rate from 10 years ago?
no, they're
Or
not. So this is, again, part of the tax planning being mandatory under this plan. You really want to look at your exit strategy and kind of defer a lot, and then as you're starting looking about 5 years out, then you start backing out and picking up a little bit of that deferral. And what we do is we say, okay, when we do the tax return, here's your deferral. So this is basically your loan from the IRS right now.
Pay now or pay later. You can't.
Exactly.
Not pay.
And that's why
Well,
this,
but with the change in the tax rate,
so actually, so we have,
somebody ending their career now, that's maybe
there are people, our clients that have done this in the last few years are very happy with us right now, because we've got someone who deferred $450,000 last year. He's going to get a permanent savings of about $90,000 in taxable income because of the new 20% law.
Right.
So that's
So-
the tax plan. That's why you got to meet with somebody, because this is very complicated. to
There's a lot of moving parts,
Our situation.
and yeah, I mean, this is something you're not going to do on TurboTax, obviously.
And you're talking to your CPA or
Yeah.
call them up, because that's.
And so these are numbers from the Millionaire Real Estate Agent book, kind of base numbers, and someone who makes $500,000 in gross income. And so it sounds nice, 21%. I only have to pay 21%. It's actually not as sweet of a deal as it sounds for a couple reasons. Number one, used to be a graduated tax, so your first dollar was taxed at 15%. Now it's taxed at 21% from the get-go. So a lot of kind of middle income earners are going to be paying more in tax at the corporate rate. Second, you still have double taxation. So with a C corporation, and this is a C corporation, not an S corporation. With a C corporation, you pay tax on the income of the corporation, and then you pay personal income tax when you pull the money out. So as it is, you'd pay, say you make $100,000. You'd pay $21,000 at the corporation. Then when you pull that money out as a dividend, you pay personal income tax on $100,000 of personal income, which would end up being 25% federal, 9% state, another $25,000 to $30,000. So your effective rate is more like 46 to 50%. So it's not 21%. It's 20% at the corporate level. Personal tax changes. The tax brackets changed a little bit. Overall, they kind of went down a little bit. So the top rate's 37%. It used to be 39.6%. They all changed by about that margin. The standard deduction is nearly doubling from around $14,000 to $24,000 for married filing joint. But the exemption's going away. So that claiming yourself and getting a $4,000 deduction, and then claiming your kids, you get a $4,000 deduction, that's going away. So there's just one $24,000 standard deduction. But there's a new child tax credit. So it used to be you'd get a $4,000 deduction and then $1,000 for all kids under 18. Now you just get $2,000 of cash. So it ends up being a wash pretty much. It used to be this phased out at $150,000. Now it's up to $400,000 is when it starts phasing out. So a lot more people are going to get this. And then the people that were in that 15% bracket, it used to be you'd get $1,000 cash and then 15% of $4,000, which is $600. So they're getting a better benefit. The sad parts, the disappearing deductions. So state income taxes and property taxes are going to be capped at $10,000 per year. So for a lot of people, especially in California, because state income taxes are so high, their state income taxes alone are at that amount. And so they end up not seeing any benefit from the property taxes. Once you hit a net income of, I think it's around 125, is when you cap out that state income tax in California. Moving expenses, so you used to get a deduction for your moving expenses if you move more than 50 miles away for work. Those are going away. Employee business expenses are going away. It doesn't apply to you guys because you're independent, so you're business owners. Mortgage interest above $750,000 of acquisition debt is going away. So how that would work is if you took out $1 million loan to buy a home, you take the total interest for the year and multiply it by 75%, 750 divided by 1 million, and then that's the amount of interest you get. So that's going to affect the really expensive homes. Probably I have a feeling you're going to see a lot of people start listing their homes at $749,900, just psychologically. They were looking at taking away deductions on second homes. That interest is still there, but as long as it's under that 750 cap. However, home equity loan interest is gone. So if you take out a HELOC, that's not deductible anymore. And entertainment expenses are gone. So it used to be you'd get 50% deduction on meals and entertainment. Now entertainment is no longer deductible. So ballpark tickets, concert tickets, all of that stuff is no longer deductible. Any questions on these going away?
What about in our case, if we do a client appreciation?
So a client appreciation party,
Yeah.
that'd be more like marketing and kind of more networking and relations, client relations, yeah. So the expense code is going to be key there.
Okay.
And then, so and then gifts is a separate thing too. You're technically limited to only $25 per person per year for a gift. IRS is way outdated on that. What happens is no one actually limits that in practicality. Small business benefits. So business owners are happy under the new tax reform. So you get, beginning in 2018, you get a 20% deduction from your net business income. So and this is a sole proprietorship too, an LLC, an S corporation, any pass-through entity gets a 20% deduction up to your net income of about $450,000. So most people are going to get this deduction. So if your net income is $100,000, you get a $20,000 deduction against your taxable income. So it's a good deal. Self-employment tax is staying the same. And then there's also some deductions for non-wage income or I'm sorry, this is a deduction against non-wage income. There are some other deductions that are based on how much wages you have, and it's an either or. Again, this is where tax planning, running the numbers specifically, sitting down individually makes sense, because there's a lot of complicated kind of numbers, moving parts. But the 20% deduction is great.
Unless you're already running as a C Corp, is that what I saw?
So as a C corporation doesn't get this, but if you're an S corporation, you get this.
Oh, I thought I said S Corp too, sorry.
Yeah, so S corporations get the 20%
Okay.
on non-wage income. So if it's $100,000 and you're paying yourself a $40,000 wage, you get the 20% based on 60.
Gotcha.
So here's some quick examples of just real life scenarios of how taxes are going to be affected. So here's someone who earns a salary of $200,000 and takes itemized deductions about congruent with someone who makes that much. Their taxes under the old law were $33,495. Under the new law, $33,529. Not much change at all. This is a business owner earning $100,000 in net income. Under the old law, $30,500 in tax. Under the new law, $24,300 in tax. So someone making $100,000 a year, $6,000 tax saving is significant. This is a married couple with a standard deduction earning $100,000 together. Their taxes are dropping $2,200. And part of that's because the standard deduction is increasing. Married couple who itemized before makes $175,000 with 2 kids. Their taxes are actually going up $1,400. And probably the reason why, like in just looking at this, would be because they're losing out on the exemption, and then they're taking the standard deduction now instead of itemizing.
For child care expenses, is there like an age right now?
13.
Is it 13?
For the dependent care, I'm not sure off the top of my head, but if you know for sure, I don't know off the top of my head on that one. So a single person making $500,000 a year with itemized deductions, their taxes are going up about $9,500. Again, recap, no more entertainment, only meals, and then the corporate tax is a flat rate, so it sounds sweet, but it's a little bitter when you actually bite into it and look at the numbers. And then back to the 7th step, we have a bonus step, step 8, that's to hire us if you need some help. So there's my email address, and then my father's. And then we do daily uploads to Facebook, and then YouTube, and then we're on Instagram quite a bit. So, yeah, thank you very much. Very engaged crowd. It was fun.
Very good, thank you.
Big up Bartolini, meeny, money, mo, and flower. You're the chosen one.